Hey guys, what's up? So we're going to be learning about Forex terminologies. Okay, so what we're going to learn is what is PIP, what is leverage, what is spread, what is margin, what are Forex orders, what is lot size and bid and ask price, what's type of Forex traders, their trading style, objective, time frames, and characteristics. This is going to be a long one. So let's dive in. PIP. PIP actually means percentage in points. Don't forget. Definition. It actually means the smallest price move that a given exchange rate can make. Now we have standard measure. This typically means 0.001. Ensure to write that down. For most currency pairs, 1 pip is equal to 0.0001. For example, if Euro USD moves from 1.1050 to 1.1051, it has moved 1 pip. You understand? So yeah, that's what pip is. One of its major importance is that it is used to measure price movement as well as calculate price losses. You understand? So it is used to calculate. So one of its major importance is that it is used to measure price movement as well as calculate profits and loss. Let's go. Leverage. What is leverage? I explained leverage before in our earlier video. So definition of leverage is the ability to control a larger position with a relatively small amount of capital. So if you have a little capital, leverage actually helps you to like trade, to make trades like you have a big capital. You understand? So ratio, there are different types of ratio in leverage. For example, 50 to 1, 100 to 1, 400 to 1. You understand? So just mind like one man, you're standing like 50 people, one man, you're standing like 100 people, one man, you're standing like 400 people. For example, so we have with 100 to 1 leverage. So with $1,000, you can actually control $100,000 because with 1, you are standing like 100. So let's go. So now, as much as leverage amplifies potential profits, the bad side also is that it can increase your potential loss as well. You understand? So in as much as you are able to like control so much money with little capital, you can make so much money, but at the same time you can lose so much money. But I'm so sure that will not be our case. Amen. So an important caution is to use leverage responsibly. And I'm so sure because you are here, that's the reason why you are going to like use it responsibly. So let's move. What is spread? Now, definition, it is a difference between the bid, that is the buy price, and the ask, that's the sell price of a currency pair. Measurements, they are usually measured in pips. For example, Euro USD has a bid price of 1.1050 and an ask price of 1.052. That means the spread is 2 pips. This is how some brokers used to make their money. And then let's say you want to like buy, maybe you're about to like place a trade right now and you're trying to like buy US dollar at 1,000 naira. You understand? They'll just like increase it a bit. So let us say 1,000.2. Do you understand? So that little profit or that little gap that's there will just like be their own profit. You understand? So that's what they call spread. In our own language, you're trying to like buy dollar for 1,000 naira. So if you like place the trade to like buy dollar, instead of you to like buy it at 1,000 naira, there can be like a little bit of gap. You understand? It can now be, instead of it to be like 1,000 naira, you cannot be buying it for, let's say, 1.02. You understand? So that's what spread means. Don't forget, all the things will make sense to you once you keep watching the video. Do you understand? So this is actually the basics, and I want you guys to like focus very, very well. So let's move. Spread represents the cost of trading. Spread represents the cost of trading and is a source of profit for brokers. You understand? That's what I said. Spread represents the cost of trading and it is a source of profit for brokers. Margin. Definition: the amount of money required to open and maintain a leveraged trading position. That's what they call margin. The amount of money required to open and maintain a leveraged trading position. Initial margin required to open a position. For example, 100 to 1 leverage a 1,000 margin is needed to control a 100,000 position. So don't worry guys, when I'm teaching you guys about MetaTrader 4, I'll show you guys where your margin is and I'll explain further about margin. So just for now, just try to like take notes and understand what all these terminologies in Forex actually mean. So let's go. So maintenance margin. Maintenance margin. It is required to keep the position open if the account balance fall below this position. A call margin may occur. Call margin. A demand by the broker to deposit additional funds to cover the potential losses. Forex orders. This is like you're sending somebody an order. Do you understand? You're sending someone an errand, or a commander is giving an order to a sergeant. So let's say Forex orders. They are the two traders used to enter or exit positions in the market. They are used to manage risks. They are used to optimize trading. They are used for strategies. They are used on different types of orders, allowing traders to specify the exact condition under which trades are executed, providing flexibility and control over their trading activities. Let's go. Whether you are aiming to capitalize on immediate market movement, set specific entry points, or they protect your investment. Mastering the following list of Forex orders will be discussed shortly, which will be for your success in trading the Forex market. What are our market orders? An order to buy or sell at the current market price, executed immediately at the best price. Because there are some times that you want to actually like place a trade. Maybe you want to buy or you want to sell, but you might not actually be like watching the trade till it gets there, or it might not be fast enough. So you can just like set an order on the trade that, okay, when market gets to this particular level, the market should automatically buy for me, or when it gets to this particular level, the market should actually like sell for me. That's what they call market order. Let's keep going. So we have a limit order, an order to buy or sell at a specific, that's what I was trying to like explain, a specific price or better. We have the buy limit placed below the current market price, or the sell limit which is placed above the current market price. Do you guys understand? So I said buy limit is placed below. You understand? Let's say market is going up, a buy limit is placed below the current market price. And when we have the sell limit is placed above the current market price. You understand? I don't want to make a mistake with that. So we have the stop order. An order to stop or sell once the price reaches a specified level. We have the buy stop placed above the current market price, triggering a buy once the price is reached. We have the sell stop. The sell stop is placed below the current price, triggering a sell once the price is reached. Don't worry, all this stuff will be practicalized and you guys will understand with real charts. So stop loss order. Now, an order to close a position at a predetermined price to limit your losses. For example, setting a stop loss order at 1.1000 when buying Euro USD at 1.1050. For example, let us say I'm expecting the price of gold to increase, for it to like go up. Do you understand? So I buy, market is going up, I'll set a stop loss below, because you make money if you tell the market to go up and you actually buy, you make money. If you tell the market to go down and it goes down, you actually make money. So when you tell the market to go up and it goes down, the more it's going down, the more you're losing money, and the more it goes up, the more you're making money. So most of the times, a lot of traders, like, it is normal for a trader to always set stop loss. Stop loss helps you to cut your losses. Do you understand? So let's imagine this is the Forex market, and market is like moving in an uptrend. If market starts going down all of a sudden, you keep losing money drastically. Do you understand? So you can set a stop loss. So once market goes down, it's just like take you out of the trade, which will not like make you lose so much money. I'm going to like explain that. I'm going to explain that well later in this course. So take profit order. An order to close the position at a predetermined profit level. Let us imagine you want market to keep going up. You understand? So as market is going up, you are making profit. You can set an order that once market gets to this particular level, it should just take you out of the market, giving, like, closing your profits. Do you understand? Because once you place a trade, you have to close the trade either in loss or in profit. Do you understand? So instead of you doing it manually, you can set a market order so that you can actually do this stuff automatically. That's what they call the market order. So I'm explaining to you guys. These are like different forex orders in the forex market. So we have the bid and ask price. So let's keep going. Bid and ask price, the price at which the market is willing to buy a currency pair. The ask price, this is the price at which the market is willing to sell a currency pair. Lot size. Now, what is lot size? Lot size, this is okay, a standard lot is 100,000 units for a base currency. Mini lot is 10,000 units of a base currency, while macro lot is 1,000 units of a base currency. Mastery of this concept not only enhances your strategy, but also help you manage your risks and increase potential returns. As you continue your journey in Forex, keep expanding your vocabulary, deepening your understanding of these key terminologies to stay ahead in the ever-evolving financial landscape. By doing so, you'll be better prepared to make. By doing so, you'll be better prepared to make informed decisions, capitalize on the market opportunities, and achieve your trading goals. Let's go. Now, Forex traders and their characteristics. Forex traders employ various strategies and style based on their objective, risk tolerance, and time commitment. Understanding the different types of Forex traders help you to identify the approach that best suits your trading personality and goals. Scalpers, we have scalpers. Traders, we have scalpers. Trading style, very short-term trading. Their time frame is actually from, we have seconds to minutes. Their objective is to capture small price movement within the day. Their frequency, high frequency of trade, often hundreds in a day. You understand? So what are scalpers? Who are scalpers? Now, this kind of people, they don't really have so much time in the market, and they have a very high and this kind of people, they have very big account size. You understand? So all these people want, they just want the market to just move a bit. They put like so much money into the market. They just want to move a bit, and once the market moves a bit and they get like profit, they just like leave immediately. You understand? They look at 1 minute time frame, most of the time 5 minute time frame, and they don't care about the higher time frames. You guys will get to like understand those time frames very soon. Now, we have their characteristics. They require fast execution and low spread. They have high stress and intensive monitoring of the market. You understand? They utilize technical skills and real-time data. These are scalpers. Now, we have day traders. I'm a day trader and I love day trading. Day trading style, short-term, they are short-term trader. Okay, let me say day traders. Their trading style, short-term trading, typically closing all positions by the end of the day. Time frame, these traders are from minutes to hours. Their objective, they capitalize on daily price movements. Frequency, let us say several trades per day. What are the characteristics of day trader? They avoid overnight risk, here like me. They rely heavily on technical analysis. They focus on, we have the 5 minute time frame, 15 minutes time frame, 1 hour time frame, so on and so forth. We have the swing traders. Now, their trading style is medium term trading, holding positions for several days to weeks. Their time frame, these people trade for days, if possible weeks. Some even go for months. Do you understand? They have, I cannot say they have little account size, but all I would say is they are looking for they want to like make a lot of profit on the long run. You understand? They just want quick money. They want something that they want, maybe they're targeting about 100 pips, some are targeting 200 pips, so on and so forth. You understand? So their objective, profits from short term to medium term price swings. Their frequency, few trades compared to scalpers and day trader, you understand. These people take few trades because once they take a trade, they actually leave it to like go for a long time, you understand. So that's it. Their characteristics: they use a mix of technical analysis and fundamental analysis because they know that market is going to like maybe go up or market is going to like come down. They focus on 4 hours and daily charts. They require patience and discipline to hold trades for long periods. Let's go. So position traders, their trading style is long-term trading, holding positions for weeks, months, and even years. Position traders, you understand, their time frame is weekly. They use weeks to years. They use weekly time frame and yearly time frame. Their objective: they benefit from major market trends and fundamental economic shifts. Their frequency: low frequency of trades, you understand. Before these guys will like take a trade, it's like very, very rarely, you understand. But trust me, each and every one of these traders are very, very profitable, you understand. Now, what are the characteristics? Heavy reliance on fundamental analysis and microeconomic factor. They focus on daily, weekly, monthly charts. They are less affected by short-term market noise and volatility. Them traders, you understand, their trading style: they use automated systems to execute trades based on predefined criteria. Their time frame varies widely, depends on the algorithm. Do you understand? So they achieve consistency and remove any emotion from their decision making. The frequency can be high frequency, that's high frequency trading, that's HTF, or low frequency trading, which depends on their strategy. They use algorithm, purely algorithm. Now, characteristics: they require programming skills and technical knowledge. They rely on historical data and backtesting, and they require continuous monitoring and adjustment of their algorithm so that they can keep making profits. We have carry traders. Long-term strategy focus on earning interest rates, differentials between currencies. Trades last for months to years. Characteristics: it depends on interest rate policies of central banks, exposed to risks of sudden exchange rate movement, requires a good understanding and global economic conditions. Now, always remember that choosing the right type of Forex trading style is crucial for aligning with your financial goals. Do you understand? It depends on your time availability, your risks, how much you can bear risks, and so on and so forth. Because I tell you I'm a day trader doesn't mean you have to be a day trader, you understand? You can be a swing trader, you can be a scalper. It just depends on what works for you. So I hope you're going to like learn so much from this class or from this video. I'll see you in the next. Peace.